We'll bring you Andrew Metrick speaking at the Boston FMA meetings right now. Hi, I'm Linus Wilson. I'm pleased to give you this video of Professor Andrew Metrick of Yale University. He's a renowned scholar. I noticed on his SSRN site that he is the 27th ranked scholar out of 350,000 by downloads, and he does very well by citations too. He's written many papers on the financial crisis of 2008-2009, and he also was on the Council of Economic Advisors for the president in the first year of the Obama administration during the height of the Great Recession. It's a really interesting talk, and he has a lot of ideas and a lot of perspective about what more can be done about managing financial crises, past, present, and future. I've cited Professor Metrick many times in my papers about the TARP, the FDIC, and Federal Reserve bailouts during the financial crisis of 2008-2009. You can get an audio version of this talk on the Finance Professor podcast on Apple Podcasts or wherever you get your podcasts.
All right, let's settle in. I'm Jeff Coles. I'm the program VP this year, and as such, it is a real pleasure for me to introduce Andrew Metrick. I have very high regard for him, both personally and professionally. Andrew deserves actually a special thanks. He is delivering the last of the research and overview sessions at this conference, and it is in significant part due to Andrew's efforts that we've had a very nice sequence of those sessions up to this point. So it's only appropriate that Andrew will be delivering the final and perhaps best of these sessions. There's no pressure. But we were working on this together, and what happened is we divided it up into two pieces. He was supposed to deliver a certain number, I was supposed to deliver a certain number, and so I immediately ambushed him and said, well, Andrew, will you do one? I said, 1 down, 5 to go. You know, so and he, in a moment of weakness, agreed. Andrew's PhD is from Harvard. He's on the faculty at Yale. He's been a dean there, and
not a real dean. Deputy dean.
No, that's the real dean. There's an outside dean that's not the, you know, you're
he
the
got
real.
to fly around the world. And
yeah.
I got to be in charge of who gets what office.
Yeah. Well, you know, faculty, human capital is very important. You have to find a place for it. He is the Jordan Professor at Yale. Andrew has a wide range of interests. I follow him for sure. He has a large number of publications in the elite journals and a significant associated imprint on thought in the profession. Pertaining to the topic at hand, Andrew served as senior economist and then chief economist for the President's Council of Economic Advisors. And the topic at hand is absolutely consistent with that, preventing and managing financial crises. Please join me in welcoming Andrew.
Thanks a lot, Jeff. It was a pleasure working with you on putting these together this year. It was a lot of fun. I'm sad to go. I'm sad this is the last one. They're quite good. People will get a chance to go to more of them. So I'm going to talk today about preventing and managing financial crises, and I'm going to be breaking a rule that I tell all of my students, which the rule I tell them is you never want to have more than 3 minutes per slide. Make sure you have 3 minutes per slide, and because people are always trying to put in too many slides. I did not follow that rule at all today. So I have way more slides than I'm going to be able to get through because I figured we'll post this on the website and it'll be up there for posterity. What I want to try to talk about today is what I think some of the key ideas are in each of these areas, preventing and managing. Each of those two areas, preventing and managing financial crises, that have come out of these massive sets of regulatory reform that we've seen since the global financial crisis. And so a little bit of this is citations of research that are out there, but that's more to set the stage. I'm not going to be trying to do an overall survey or overview of all the research in the area, just to try to get to what I think some of the key questions are. Also, this is sort of a workshop-y kind of a thing. I'm not, this isn't a class, so feel free to interrupt away and ask questions. It looks like most of the people in the room here, I won't talk about age, have more of their research careers in front of them than I do. So I hope to encourage people to work in this particular area. I think it is by far the most important thing in my now more than 25 years in this profession that has come out. I totally changed my own research program after the financial crisis. I pretty much only do this now, and if I had more of my career in front of me, I'd be excited to tool up and just focus on this exclusively. So the young people, I'll say it now, have a lot that they can do in this particular field. And I'll try to explain why I think that's true. All right, so the outline of this talk. First, I'm going to just give a bit of a sense of what's happened in the regulatory world since the global financial crisis in a few major jurisdictions. Most people in this room probably are familiar with what's happened in the United States, but a lot has happened in Europe as well. And I just want to give the lay of the land so you can just see how much there is to do. And then I'm going to do the two topics. One is preventing crises. We've done a lot on prevention, and there I think the key tension is between, all right, well, let's make sure these banks don't fail, and we put all kinds of regulations on banks, and then you just get migration out of traditional banking into what we call shadow banking or some other kind of banking. And that's a big tension. And a lot of the research in this area is very partial equilibrium. It's like, let's look at banking, figure out what to do about banking, and ignores that. And that's why I think there's a ton to do, because we're really just at the beginning of understanding that migration and getting a more of a general equilibrium sense for crisis prevention. Then there's this topic, which I think gets less attention than it deserves, which is the management of financial crises. You know, right after the crisis, there was a lot of good work that was coming out of the Federal Reserve, central banks around the world, on all the different programs that were done. But that's kind of died off. You know, the problem is that these things are all seem very idiosyncratic. How are we going to learn all that much from them? And anyway, all the action is what we're going to do to bank capital rules tomorrow, and how we're going to design the rules that are still in place. Thinking about how we'll react to the next financial crisis, which may not happen for 50 years, isn't that exciting to people, I think, which might explain why there's not as much work on it as I think there should be. And I think it's a really ripe area. There, the big tension is between moral hazard and stigma. So there's a lot of concern that if you have some kind of program to help distressed institutions, if you actually help them, if you bail them out, you're going to create an enormous amount of moral hazard for the future. And so that gives you a tendency to make sure that whatever program you put into place is extremely punitive. But if you have a very punitive program, then the market infers anyone who's gone to that program is really in bad shape, makes them want to run even faster from them, and you create stigma. And the tension between those two things can make it very difficult to design a program that'll work. And that tension, I think we see people exploring in some of the programs from the GFC, and there's just a lot more work to do. So those are the themes, but now let me go into some details. Okay, so just by way of introduction, microprudential regulation, that's most of what people studied when they thought of financial regulation before the crisis. And it was a somewhat sleepy field. I had colleagues who worked on it, and I used to tease them that it was boring and sleepy, and they all got the last laugh, because all this regulation stuff was turned out to be very interesting. But it was all very micro then. And what I mean there is the goal was protecting depositors, investors, consumers, and government insurance funds. We kind of thought about it at the institution level. And that type of regulation has been around in the United States since the 19th century. Really, any time that you had the licensing of banks, which goes back to having banks, and governments existing at the same time, there was something like microprudential stuff going on. In the United States, we have many institutions that do this. Federal Reserve, the FDIC, OCC, you can see all of our acronyms, state banking regulators, state insurance regulators. For markets, the SEC, the CFTC, state securities regulators. So there's a lot of actors in this space. This is a space about dead weight loss triangles, for the most part, right? You know, we're really trying to, we understand that there's imperfections in these markets, there's asymmetric information. We would like these markets to work as well as they can, but it's not, most of the research in here is not about crises, per se. Macroprudential regulation is a relatively new term. There, the goal is protecting the whole financial system, minimizing externalities of failures in that system. The focus, instead of on being on individual institutions, is on the interconnections among institutions, markets, and the real economy. The formal authority for macroprudential regulation is new or significantly increased since 2008 in virtually all developed countries. What I should say is that people use the term, but when I say macroprudential regulation, I'm talking about crisis prevention. Okay, so that's not the only meaning of it, but for the purpose of this talk, I'm just going to use them synonymously. So we do macroprudential regulation to prevent a crisis. Okay, there's a ton of work to be done here. I would say maybe we're a little past 1935 now, maybe we're in 1938. We're not that far ahead of what the understanding was of monetary policy as of the Great Depression. If you go back and read what people were talking about when they talked about what we would now call monetary policy leading into the Great Depression, they had absolutely no idea. It didn't occur to them that if you tighten monetary policy, this might actually be very harmful to the banking system as you go into a recession. Might make things worse. They just didn't really have that. They didn't have a model in their head for that. And I would say that for a lot of what we would think about as crisis prevention now, if you look at the state of the literature, we're fumbling towards having, there's no canonical model that would help us here. There's not one thing that we can point to. We're fumbling towards it a little bit, but there's a general sense, there's a lot of talk these days, I'll talk about it a little bit, of safe assets and safe asset policy, and why we should have a safe asset policy instead of just a monetary policy. But there's no formalization of this. There's just a lot of people kind of writing about it, where we were, I think, on monetary policy. So there's just a ton to be done here. We have to think about what are our objectives. It's not even obvious. So obvious, we would think, well, I'd like to prevent a financial crisis, okay. But if I told you for sure that you had a dial, and if you turn the dial, you know that you could make the financial crisis less likely, but at the same time, you would increase the cost of capital a little bit. So once we construct a perfect system, even then we're going to have a dial that we would be turning a little bit. Then, you know, you could make it a little bit safer, but at some repressive cost to the system. We don't have that. We haven't figured out what that would look like, what that trade-off would be. You know, we have some notion of a Phillips curve, or even a rational expectations notion that we have a trade-off between unemployment and inflation in the monetary policy world. We don't really, no one's calculated this thing for crises. So what are the right state variables to look at? What instruments should be used? We threw out a whole lot of instruments in the last round of regulation, liquidity instruments, bank capital instruments. We have stress tests, which enable us to do all kinds of scope restrictions after the fact on institutions. But what are the right ones? We don't know. So I would say, again, it's very much the beginning. And with all of the data that's going to come online as we roll out some of these new policies, and they get rolled out in kind of very nice quasi-natural experiment ways across different jurisdictions, there's just going to be a ton of work to do. Okay, so what's this institutional legal background that we have here? I have slides on each of these things to go into a little more detail of legislation that touched almost every part of the financial regulatory system. It's like the New Deal legislation all rolled up into one. The 33 Act, the 34 Act, 1940 Investment Advisors, all these things rolled into one. And in particular, with regards to macro-prudential things, it was really the first time that we had done anything systematic in the United States. The United Kingdom was able to wait 2 years longer to get theirs done. I mean, we in the United States got Dodd-Frank Act passed in July of 2010. I'm certain we would not have had any kind of law past the midterm elections of 2010. when the Democrats lost Congress, lost the Senate. So basically, at this point, this is sort of all you can really, the only time they could have done it. But it would have been better if they waited. It would have been better if they could have waited, because we learned a lot between 2010 and 2012. And the Financial Services Act in the UK, I think their system is a little better. It's a little more flexible. And I'll talk a little bit about that. European Union, you can't just write one thing. There's a whole lot of stuff in the European Union. And they all have different names, like directives, and they're not really laws. They have their own nomenclature. But a lot of interesting things, so I'll talk about that. And then on the international front, we've had a third round of Basel, a very significant set of changes to the banking, banking regulations that are proposed, and the introduction of the Financial Stability Board, which is an international cooperative group that really thinks a lot about systemic risk. They produce a lot of interesting reports. There's sort of good risk for people who want to do research is to stay on top of their website. Okay, so let's discuss the U.S. first. Okay, so I'm just going to mention 5 things. 4 of them are about prevention. The other one is more about management of crises. But I'm going to lump them all together as we talk about Dodd-Frank. The first is the creation of the Financial Stability Oversight Council, or FSOC. And the Financial Stability Oversight Council is a council of the heads of all of the regulatory agencies, financial regulatory agencies in the United States. And they actually have some bite. It can do some things. And it's tasked with kind of looking for the gaps that are out there in the law, looking for things that maybe the SEC on their own wouldn't be paying attention to, or the OCC, the Office of the Control of the Currency, wouldn't be paying attention to, but perhaps somebody should be paying attention to. And also can ask a specific agency that might have responsibility for something, but might not be thinking about it as part of their mandate, because their mandate may not be systemic risk. The FSOC's mandate is systemic risk. They can go to that agency and say, hey, there's a problem here. You guys should do something about this, or explain to us why you're not doing it. So that's among their powers. They have underneath the FSOC, sort of the secretariat for the FSOC is the Office of Financial Research, which employs a lot of economists now, a couple hundred people, doing data collection and economic research on systemic risk. And they provide research that can be used all throughout the government, particularly to help the FSOC. Very interesting place to work, which hopefully won't go away. It's in some danger, but we hope it won't go away. The Financial Stability Oversight Council can designate, this is perhaps their most powerful, most important function, and it's one that is tremendously contentious, which is that they can designate an institution, a non-bank institution, as being systemically important. And then that institution comes under the oversight of the Federal Reserve. Now, that's very important because Lehman Brothers, AIG, they did not have systemic risk regulators. They did not have regulators who cared about systemic risk. So AIG has, as we know in this country, we have state insurance regulation. There was no national insurance regulator looking at them. They owned a thrift, but the Office of Thrift Supervision wasn't really paying attention to systemic risk. Lehman Brothers, their overall comprehensive regulator was the SEC. The SEC wasn't thinking about systemic risk, didn't really consider that to be something that they should be worried about. They're worried about disclosure and about markets functioning well. So there is no Lehman Brothers anymore, but AIG was designated systemically important, although they've now just voted and maybe they will be removed from that list. But for a while, they were on that list. They designated MetLife. They tried to designate MetLife. MetLife sued, and so far is winning. But the idea here is that when you are large and you might be systemically important and powerful, you don't get to have, your state regulator in charge of you anymore. The Federal Reserve can be. Yes?
Probably you will want to answer this later, but do we know how much transaction cost or capital cost increase for the systemically important institutions?
I'm going to talk about what it would mean to have what capital requirements might mean in terms of cost in general, and we can think about it specifically for this case. you want to say that that overall there's a real, this makes it so difficult to do this type of regulation. This doesn't answer your question yet, but hopefully I'll get to it later. But this is somewhat of an aside to it, which is that the people who don't like government bailouts and government helping banks say this is terrible to designate them because you've designated them as being too big to fail. You've said you're too big to fail and we're gonna, watch you really carefully, and everyone kind of knows that means you'll get bailed out. And so there's a part of the world that looks at this and says this is terrible, this is your bailout list. And then of course there's the institutions themselves who will, hire billions of dollars worth of lawyers so that they're no longer designated. So they certainly don't think that that means that they're going to get bailed out. So there is a question: is this good or a bad thing for that particular institution? Most certainly, if we throw out any notion that this actually makes you too big to fail and lowers your cost of capital because of that, they're not going to like this because it's just more regulation. It's just more oversight. Perhaps you have to hold more capital, but not necessarily. Not if you're a non-bank. So there are rules for systemically important banks that go through Basel. So there's rules about holding more capital if you fall into certain categories. That's different than designation because you're kind of, in many cases, you're falling under more of international rules or just rules that the Fed might. You're already regulated by a bank regulator and you're just sort of falling above a threshold. They make you hold more capital. This one is also important and under some stress right now. This is a completely new way to do resolution/liquidation of a large, systemically important financial institution. Again, take AIG or Lehman as examples. The only choices that existed for the US government in 2008 were either bankruptcy or bailout. That was all that existed. Neither worked out well, in some sense, right? Bankruptcy for Lehman almost brought down the whole world's financial system. And the bailout of AIG almost brought down our political system. So neither is great. And the idea here is, well, let's have some middle way, something that's other than bailout or bankruptcy. And orderly liquidation, the first draft of Dodd-Frank called it orderly resolution. And people said, no, you can't have that. We don't resolve, we liquidate. Okay, so it got changed to orderly liquidation. That enables you to take a systemically important financial institution through a resolution-like process like we do for a failing bank. Okay. Now, I should point out, you do not need, this is a distinction that is an important distinction. You do not need to be designated as systemically important prior to being brought through orderly liquidation under Title II of Dodd-Frank. Also, if you are designated as being systemically important, you do not need to be brought through Title II of Dodd-Frank. You can still be forced into bankruptcy. So there's no sense in which when there is designation of, let's say, AIG as being systemically important, that means for sure, if AIG is in trouble, they're going to get taken through this orderly liquidation process. They can still be made to go bankrupt. And in fact, the FDIC, they will fall on their swords and they will tell you, Title I bankruptcy is our first choice for everybody. Everybody has to write living wills. Everybody's going to go through bankruptcy. We absolutely refuse to take anybody through Title II, orderly liquidation. They will say that over and over and over again. That is the party line. Okay, so it doesn't matter if you're designated, we're still not going to use this. But this is what we have, completely untested. Okay, so we have another financial crisis. We have now, as opposed to FDIC resolution we've done hundreds and hundreds of times. This is kind of similar. It borrows a lot of the same language from the statute that enables FDIC resolution to happen for small banks. But of course, it's a very different animal if you're going to do this for AIG. And the literature is almost completely silent on what the impacts are. And I can tell you that this was one of the things that I worked on when I was in Washington. There are paragraphs in there where people fought like crazy over certain language in these things that I think is extremely consequential. And we don't really, we don't even have like a model to grind it through to figure out whether it's consequential. I'll just throw out one example. This is a random example. So when you take a large institution through resolution. So Title II is the part of Dodd-Frank that says, all right, we're gonna all turn the key. The FDIC, the Federal Reserve, and the Treasury all say, time to take AIG or whoever through orderly liquidation. Once they say that, then there's a certain amount of time that they have to decide what things that were in AIG are going to get thrown into a stub that will go bankrupt, and what part will go into a bridge bank that can borrow from Treasury and will continue to operate as it slowly winds down. And the question is, how long should they have to do that? How much time do you want to give them? Well, this seems like a very consequential thing. If you give them, as some of the early drafts had in there, 5 days, it's like an enormous, I mean, 5 days, you're going to think, oh, 5 days is too short. But actually, 5 days is so long that anybody who thinks this might happen is even a little worried about this happening runs way, way before. Like there's even a hint of Title II. There's no way they can wait 5 days. So the language that's ultimately in there, you know, they have them waiting 3 days. Okay? Well, if they wait only 1 day, then of course there's no way they can make up their mind in 1 day. It's impossible. So they'd have to write the rules down in advance. There'd be no way to actually do it beforehand, which would have created a different level of uncertainty. But how do we even think about that? Well, there's lots of different regimes around the world that have these different things, and go out and look to see what data we have, at least for smaller institutions. But that's one. I mean, I'd say all over Title II, there's all these things, and then the rules that have been written for Title II afterwards that give guidelines. In each one of these cases, there's a question about, you know, how will this work in practice? Another thing which I'll talk about less today, but it's a fascinating area, and for anybody who is interested in it, it's the work of Darrell Duffie. You just go to Darrell's website and read what his research in this, you'll know what you need to know, which is that in the crisis, there were some enormous problems, say in 2 different cases. In Lehman Brothers, when Lehman Brothers failed, there was an enormous amount of breakage in the bankruptcy from their swaps positions. They actually had a flat book in swaps. But because of the way that derivatives work in bankruptcy, with people being able to use, they have a safe harbor, they can kind of unilaterally get out of transactions, and the way that Lehman was forced to post collateral in advance, the estate lost an enormous amount of its value. You know, a big chunk of why their debt ended up at 20 cents on the dollar was because of the breakage in bankruptcy. And that was because this whole market was over the counter. So a lot of people thought, well, one way to try to fix that is just move more of that stuff into clearinghouses, because then, to the extent you have a flat book, you're not going to get that kind of breakage. You don't get breakage like that on your exchange-traded things, for example. We didn't see that. So that's one motivation for doing it. Another motivation for doing it is like AIG had enormous, they did not have a flat book, they had enormous exposures. But no one counterparty knew what their exposures were. There was no one place where we could say, oh my God, they get downgraded, this is how much collateral it's going to cost them. This is what the overall exposure just wasn't in one place. And the regulators, you could say, well, the regulators should have been paying attention to that. But even a very good regulator, in the absence of a clearinghouse, I don't know how you go through 1 million transactions and add these types of things up. So now, under Dodd-Frank and under similar types of rules in Europe, a lot more of what used to be over-the-counter, it's not exchange-traded, it doesn't have to be traded on an exchange, but there needs to be reporting of prices, and in some cases, the centralized posting of collateral. There's a huge number of questions about that. I'll mention a little bit of them later, but we don't even know things like, how different is it if we have 3 central clearing houses versus having 2 versus having 1? Darrell Duffie has some research saying unambiguously it's better to have 1 than to have 2, and better to have 2 than to have 3. But you might think, well, if I have 1, then I have all the risk in one place. Yes, but of course, if you have a bunch, you lose all the value of the netting, which is why we want to have these things in the first place. So Darrell's done some excellent work, but he'd be the first to tell you that we're just at the beginning of understanding that. Okay, so in the UK, they have, so in the United States, of course, we have this problem because we have a very balkanized financial regulatory system. It's very balkanized. And it's almost impossible to fix. This is a backdrop to then talking about the UK. So for example, in the United States, we we have the SEC and the CFTC. This is just one example. And they used to be really different. The SEC dealt with financial products, and the CFTC was doing hog futures, or hog presents, spot markets for commodities and things. That, of course, has changed a lot over time, and now the CFTC is doing financial derivatives on indices, and the SEC does financial derivatives on individual names. But there's a lot of overlap between what those two regulatory agencies do. There's one example of a million things. So you would think a logical thing to do would just be to put them together. Okay? And in fact, people who work at the CFTC and even people who work at the CFTC who would get largely swallowed understand that that would be a very good idea. A lot of people think this would be a really good idea. And it was proposed in early versions of Dodd-Frank, but they couldn't do it. They had to drop it. And they had to drop it. Why? Because for historical reasons, the CFTC is overseen by the Senate Agricultural Committee, and the SEC is overseen by Senate Banking Committee. And if you're on the Senate Agricultural Committee, you get 90% of your donations from companies from firms that are regulated by the CFTC. You don't want to give that up. So essentially, Democrats who sat on that committee, who should have been in favor of a Democratic presidency, said, well, we can't, there's no way we can give this up. Just leave these two things separate. This kind of silliness, right, that we have that makes it hard to fix things in the US. And in the UK, they have an advantage and a disadvantage. Their political system is an advantage and a disadvantage relative to ours, which is that the parliamentary system that they have enables them to be a bit more nimble when it comes to these things. And nimble means they can be a bit more patient. So they were able to wait a couple of years until they had a better idea what went wrong, and then they were able to write down a law that made more sense and get it passed, because they didn't have to worry about they didn't have the same type of lobbying problems that we had. Now, there's a downside to that. Paul Tucker, who was deputy, the number 2 person at the Bank of England during the crisis, has said at post-Brexit that in the United States, the United States is terrible at kind of making normal laws, but very good at constitutional laws. We're good at constitutional laws because we don't do them. Okay? We don't make huge, we can't. It's impossible. Okay? And he says, whereas the UK is very, very good at making changes to their laws, but that flexibility means that if they want to go and do things like leave the entire European Union, they're able to do that. Can you imagine? We could never vote on something like that in the US. So that's the advantage to their system, is that they can easily write a law like this. The disadvantage is they can vote on Brexit in a referendum that nobody knew was coming. Okay, so upsides and downsides. So what they do, they created 3 new bodies in the Financial Services Act. The Financial Policy Committee, the FPC, that's an analog, it's kind of an analog to the Financial Stability Oversight Council, the FSOC in the US. Has the same kind of overall look out for systemic risk things, make people fix stuff up if you don't like it. It is, however, a committee within the Bank of England. It might have been better if we had empowered the Fed to do this instead of requiring them to cooperate with 9 other agencies with different mandates. But it has the same type of job. They took their the Chancellor of the Exchequer, sort of their Treasury Secretary, has veto power in a crisis if public funds are to be used. We basically have that same thing now in the US. The Treasury Secretary has a lot more power to veto stuff. That's going to be done by the Federal Reserve, to be informed about it and to have the opportunity to veto it than they did before. Okay, the EU has done a whole variety of interesting things. Also here, this I suspect is going to be the place where, it's always like our smart friends from Sweden and the Netherlands who get these cool data sets, because they're doing fun things now, fun for us as researchers, not fun for the people who are doing them, with all the banking problems that they have in Europe, because they've created a whole bunch of new rules, and they're actually trying them out, doing things. Like they'll create a whole rule that says you absolutely must bail in certain types of debt before you can put government funds into any kind of financial rescue. So they put that rule in, it's like in the big rule, it's all over there, it's a directive, all the countries have adopted it. And then they find out that, every single time they have to deal with a bank, they're unable to do the bailing. It's just like politically impossible. Okay, so they get to have examples. We don't have too many examples right now in the United States because we mostly fixed our banks 6 years ago. So what they do here, they created the European system of financial supervision. This just doesn't exist before. It's a totally new thing, the ESFS, and it has 3 supervisory authorities: European Banking Authority, Securities Market, Insurance, okay, and the European Systemic Risk Board. So this is Euro area, EU-wide, not just Euro, EU-wide. And EU-wide things don't actually have a whole lot of power. So they're really just trying to write rules, get everybody to sign up to those rules, make things consistent across the Euro area. The real bite exists in things that have been created inside the Eurozone. And that is the single supervisory mechanism. So now they've moved. It used to be the case that banks all were supervised by their national authorities. You're a large bank in Spain, it was the Bank of Spain, or whatever the regulatory agency was in Spain that looked after you. Deutsche Bank, Germany did that. Now, the 135 or so largest European banks are all supervised centrally. Okay, so this is all another interesting thing that you can immediately do, which is there's interesting cutoffs there for whether you're supervised centrally or not. And looking to see what the banks do that is different. They also instituted the single resolution mechanism. This is the thing that they keep kind of trying to get to work, but it's not working yet. And they've had a few opportunities to try it out. This is also just the Eurozone. This has a few different components. It has a fund. This is like what the FDIC would be doing in the United States. It's sort of the receivership aspect of it. There's a single resolution board, which is an independent EU agency to ensure the orderly resolution of failing banks, and the single resolution board manages the single resolution fund, which then has to work with various national funds, which together make up the single resolution mechanism. Then there's another animal called the European Stability Mechanism, which is different than this because it's not specifically about banks. This is more to help sovereigns. Okay? But of course, sovereigns are almost always in trouble because of their banks, at least in recent experience. So this is it's this and the precursor to this that were helping out the countries that were having sovereign default problems, that were kind of going and helping out Cyprus, right, which is ultimately getting in trouble because of its banks, but being helped by the ESM. So they have a variety of mechanisms, and this, I mean, it's hard to, I can't really think about things like this. Think about how many papers get written about just one of these things would be worth, 100 papers. We get all of them at once. It's an embarrassment of riches. And in Europe, they're actually doing stuff. So there's, if you can speak any of those languages, it's worthwhile to figure out what it is they're doing. Okay, Basel. You probably know some of this history, at least, but there was no capital requirements the way we think of as capital requirements for banks prior to the 1980s. Individual regulators did things, and they looked at capital as one of the capital ratios, as one of the inputs into their supervisory decisions. But there was no formal, until the Basel agreements came along in the 1980s, the Basel Accords. There was Basel I in 1988. There was various amendments to Basel I over the years. Basel II in 2004, which the United States never adopted. Okay, so we were on Basel I, various amendments to Basel I right up until the crisis. And then Basel III, which was agreed to 2010, 2011, and is now getting implemented all over the place. Basel III is quite novel. So it has rules for capital, higher capital requirements in general, but also more complex measures of risk, and a variety of steps, depending on how big the banks are, with extra buffers that go in. It also introduced liquidity rules for the very first time. Liquidity rules are very funny to financial economists when we hear them for the first time, because it seems logical to lay people. They say, well, these banks, they're lending long, they're borrowing short and lending long. They're very unstable. This is crazy. You say, well, that's a bank. That's what a bank does. Okay, so Basel is trying to basically cut down on the amount of banking done by banks. So the logical thing to happen there is some of that activity is going to move outside of banks. Okay? But these are completely new rules. It's shocking how few papers are on this. I mean, there's a lot of papers about liquidity, but in terms of papers about the liquidity rules and what the bite of these liquidity rules will be, I'm writing a survey now, and it's just like a handful, and that's it. Because it's so hard to, they haven't been implemented yet in a lot of different countries. So you got to go look to historical examples, like reserve requirements are kind of like liquidity rules. The way we had legislation in the United States in the 19th century about the National Bank Act, requiring everybody to always back up collateral U.S. government bonds for any banknotes they issued, is kind of like the liquidity rules. There's some similar types of rules that have been passed in Europe pre-crisis that people study. But these are going to get rolled out across countries in a staggered way over the next 6 years. It's just like a dreamland for researchers. Not so much for banks. Okay, so this is the, I promise, the key tension. The key tension in macroprudential regulation is between the desire to put strong regulation on systemically important institutions versus what will likely happen, which is the migration of activity outside those institutions. This is a constant theme, right? Which is, if you're going to put stronger capital requirements, you're going to put stronger liquidity requirements. You're going to say, here, banks, here's a million rules for you and scope restrictions. What's likely to happen is you shrink your regulated banking sector, and your shadow banking sector gets bigger. On the other hand, you can't throw up your hands and say, well, okay, well, I'm not going to do anything. So I think basically the research in this area has to be very sensitive to that. I'm going to illustrate that just by talking about the bank capital example, just sort of some very simple results from the literature about bank capital that show why this is important, but also show why a lot of what we currently do, well, this huge literature we have on bank capital, just might not be the first order thing to worry about anymore. And now in this new world, we should be worried about, we need to be thinking about migration much more and less about calibrating bank capital models that we did in the past. Okay, so that's what I'm going to talk about now. Here, so from a bank capital perspective, we think like, what are the rules from Basel? What are the rules that any jurisdiction has for bank capital? You're basically telling a bank, you have to hold, let's ignore all the fancy first tier and risk-weighted asset stuff. Let's just think about it. You have to have this much equity for your assets. You have to have this much equity. How are we going to measure your assets risk-weighted? Material for the value of their firm. So if you go, for example, to, I don't know what McDonald's capital structure is right now, but let's say McDonald's capital structure is that they're at 20% equity and 80% debt. I'm just making that up. And you go to them and you say, you must go to 30% equity. You have to go to 30% equity. There was a new, Dodd-Frankfurter law that said that McDonald's has to go to 30% equity. McDonald's, I'm sure they would complain and they'd be really angry, but most of them would just think it was strange, right? So, all right, fine, I guess so, if you force us to do it, and no problem, right? You can deduct one, you can't deduct the other. The first thing to recognize from that is that really shouldn't, that's not a social cost. Privately, the banks might care about that, okay, but a tax deduction, if the only reason they want to have a lot of equity, a lot of debt, not a lot of equity, is a tax deduction, then maybe tax policy needs to be changed. Okay, but even more to the point, they shouldn't lose their minds over it. Kashyap, Stein, and Hansen, in a very, very readable paper, I'm going to show you some of their results, just do a calibration, and they say, well, how big could this be? 1 or 2 basis points per percentage point, right? There's a convenience yield to holding it. Skander Van den Heuvel put together a very nice model just trying to estimate, well, what would the value of that be? Because that's where a lot of bank profits come from. They're basically earning a convenience yield. And there's a debate that's out there, and where Kashyap, Stein, and Hansen come out as kind of to agree with Admati that, yeah, okay, there's something there, but it's just like, again, another basis point or two. It's not a big deal per percentage point of capital. So what would it be? Okay, another thing would be too big to fail insurance, right? So what would be a violation of Modigliani-Miller? Modigliani-Miller assumes that, you change your equity debt ratios and the risks move on these two things to kind of offset it so the overall cost of financing your assets is the same. But that wouldn't be true if kind of the government helped your debt more than it helped your equity. Like he said, oh, don't worry, you can always borrow from these guys because we'll always make sure you get paid back in full. And again, the nice thing about the KSH paper is they try to go through and grind this out, given the data that's out there. They try to say, like, how big are these things, really, if we think these are the reasons? And when they add everything all up together, they don't get a huge number. Okay? They get 10 or 20 basis points for adding, so I think what they get to in the end is like 10 or 20 basis points for adding 5 percentage points to the overall capital ratio. 10 or 20 basis points to the cost of capital banks, which is not nothing, but it doesn't seem like they should go, you know, the whole industry wouldn't be destroyed. You know, we're going to move down the demand curve a little bit. But what they point out, and this is crucial, and I'm going to show you a little bit of evidence from their paper on this, is that competition in banking drives leverage ratios higher and drives competition with unregulated intermediaries or shadow banks. So when the banks are saying, look, if you tax us just this little bit, you're going to kill us, they're not really, they're not crazy. It wouldn't be crazy if you think of banking and the services provided by banking as having close substitutes outside of the regulated banking industry. Okay, so to keep pushing this analogy about banks, if you think that about banks selling debt, if banks' business is actually selling debt, that's what they do, right? So I want 80% of my balance sheet to be debt because that's what I'm selling. I don't sell shoes or hamburgers. I sell debt. Okay, then telling a bank you have to have 20% equity would be like telling McDonald's you must sell 20% chicken McNuggets. Okay, that is your business. And yet there's this unregulated burger joint down the street that doesn't have to do that. So most people might just want to go down the street, so they have to deal with all this chicken stuff. They want them to specialize just in burgers. Okay, so what's going on here is you're actually altering the competitive landscape with having these rules relative to the competitors that they have that have learned how to do maturity transformation and other forms of banking activities without being under the umbrella of a regulated bank. Okay, so let's see what's the evidence for that? Okay, so the KSH figure 3. Figure 3 is just going to show that size and leverage are positively correlated. It's just an appetite, just to whet our appetite. Okay? And these wonderful pictures here with lots of dots in them, the key is down here. You can all read that, right? Yeah. I'm going to give you the basic idea. It's very simple, which is, and you go in this direction, the book equity to book assets, in this direction the banks are getting smaller. Okay, so essentially the biggest banks have the smallest book equity. This is over time, and these are just by quintile of bank. Okay, so the higher the line goes, the book equity to book assets is just higher. The smaller the bank, the smaller the quintile that we're in, the more equity they have. It's just sort of a funny thing. It seems like big banks tend to be more highly levered. And it's the same thing over here using risk-based capital ratios instead of just equity, instead of just book equity. Right, so that's just to whet our appetite. Why would big banks be more highly levered? Well, big banks are much more likely to be competing with other banks, including other big banks. Small banks, particularly historically, when we go back here, back to the 70s into the 80s, there wasn't. You could be a small bank that had no competition because of branching restrictions in those days. All right, so let's actually take advantage of this nice natural experiment we did in the United States with branching restrictions and the loosening of branching restrictions in this now kind of famous way to attack problems in banking, and look to see what that did overall to ratios. So what they do, this is from KSH, they're going to do this kind of standard straight hand kind of exercise where you look at states that over time got rid of either interstate branching restrictions or intra-state branching restrictions, and they're just going to do a diff and diff type of analysis. You got a nice big panel, and we're just going to try to figure out what happens to the equity to asset ratio in a state when there is deregulation. So deregulation means all of a sudden I'm competing with more people. Okay, so it's a nice measure of competition, and all that matters here, I mean, you can look at it, the dependent variable, here's the dependent variable is the mean. So what happens when you use either intrastate, you've deregulated intrastates, this is just a variable that goes from 0 to 1. Was 4 times GDP in 1952, and it climbs to about 10 times GDP. Total amount of assets climbs to about 10 times GDP in 2010. In red, we're just going to do financial assets. So we're taking out, houses aren't in there, fixed equipment isn't in there. So just financial assets. And over here, that's the right scale. And that goes from a little more than 1 to 4.5. So the total amount of assets to GDP ratio in the United States looks a lot like, from when we first started to study macro, it looks a lot like these very constant ratios that you get of output to money. Right? There's a notion in which, of financial assets, this isn't of total assets, this is of total financial assets. Okay, so this is safe asset share of total financial assets that are out there. So you have a certain amount of total financial assets. Some of the safe stuff is basically used to support everything else. It's like lubricating it. It's like transactions. You can use this stuff in transactions and as collateral. But look where these safe assets are coming from. 1952, 80% of safe assets were coming from deposits. This was like a very bank-centered system. You want to do something to the financial system, you go and you tell the banks, we want you to behave differently, hold more equity or do something. Okay. But where these safe assets get produced as now over all this time, and again, remember, as a fraction of total assets, it's staying about constant. But where is it coming from? By the time we get to 2010, we're at about 30% of it coming from bank deposits. And the rest coming from all these other things. Securitized debt, corporate bonds and loans, other liabilities. Other liabilities are this category up here. A lot of the other liabilities are mixing up some of the things from the other categories. So we're no longer in this total bank-centered system that we're in here. And we can't think that just by going in and changing bank capital requirements, we're somehow going to make the world safe. All right, what are some I'm calling these semi-stylized facts. There's not enough here to be stylized. Okay, so they're sort of stylized facts. The assets to GDP ratio is increasing. Financial assets to GDP ratio increasing even faster. The share of all assets that could broadly be considered safe or money-like or information insensitive, that's Gary's favorite term, has remained relatively stable, with government and financial components acting as substitutes. That's going to be an important point, which I'll mention below. Within the financial debt component of safe assets, the share made up by bank deposits has fallen with its place taken by a broad range of shadow banking creations. That's very long run that I just showed you. This actually works incredibly well at short horizons. If people are familiar with Adi Sundaram's RFS paper from 2015, which is just a very, very cool result, he shows that essentially if you just track what's going on in the convenience yield, which is like a short-term measure for what's happening in the convenience yield, which is like a short-term measure for what's happening in the spread between treasuries and some other risk-free thing. It was telling you just how scarce treasuries are. Or if you look at just how much revenue the government has brought in one week versus another week, which is somewhat random, it's fiscal, it's not a monetary thing, you can observe at weekly horizons more asset-backed commercial paper being issued. So in other words, we get a little increase in the spread of the convenience yield, more asset-backed commercial paper gets issued. We had a student at Yale who did the same thing, a very similar type of thing, looking at actual securitizations. Like when you have all this stuff sitting in your warehouse, when do you securitize it and throw it out on the market? Well, when do you do that? You do that in a week where the convenience yield has popped. Okay, so over very short horizons, the financial markets are quite good at manufacturing. All these things, really to do them well, is going to require some better kind of grand macro model. This is outside of just finance. We need a macro model that has intermediation a little more fundamentally part of it. Right? What's happened since the crisis is that, the DSGE world, and they're very sophisticated people, but they've kind of just grafted on top of their models and financial intermediation. Instead of it being kind of part of the system to begin, it's like we have this big, huge system, and now we're just going to put this little pipe from here to here. Okay, and they're not built to help us answer these questions. Okay, big open questions continue. Now getting more specific. This one is a very active debate for which it's very political, this particular debate. The FSOC in the United States can do this thing they call designation. And it's died down a bit now because I think the industry has won, but there was a big fight at one point about whether they should designate large asset management firms. So BlackRock, should BlackRock be designated as systemically important? And BlackRock have successfully argued that we don't really, yeah, we have a big balance sheet, it's not our balance sheet, we don't actually have control over these assets, we're a custodian for other people. Sometimes we're an agent for other people, but that's different than what it is for a bank. And furthermore, you shouldn't, why are you going after us? What you should go after is some specific type of activity that's done by these institutions. So if you think it's really dangerous, this one little thing that's done by some institutions, well, don't just go after us, go after the activity. And there's a certain sense to that. On the other hand, it's very hard to know where all the activity is happening at any point in time if you're a regulator. So it's also a bit disingenuous because it's like, you know, hey, nothing to see here, but the thing is you won't see it anywhere else either. But we don't know how to do this. If you decide that it's institutions, because at least you can see them, I know when there's an institution that has a $200 billion balance sheet. I can observe that, okay? So I'm going to watch you really carefully. But how do you decide? There was an attempt to write down a set of rules. The Office of Financial Research wrote a report for the FSOC where they tried to write down a set of rules. Here's what you should do to designate. And then, like, the whole world came crashing down. The industry pushed really hard back against that because there was no research. There was nothing that we could give them from the academic world that would enable them to get help. And then this is something I mentioned earlier. I haven't talked a lot about in detail. It's a technical area. So for people who are technically inclined, there's a lot of the newer tools, particularly like tools of network theory, that can be brought to bear on questions about central clearing. And in fact, a lot of the most interesting papers here you'll find in the OR literature because they apply some of their network models to understanding how clearing would work. But we can't even answer this yet. In fact, the key paper in this literature, Duffie and Zhu, they show a model, and at the end they say, all right, well, we don't know, right? And that's, which is a wonderful thing to see in the STEM paper in the literature. It means there's lots to do. Okay, so I've taken most of my time on prevention, as I expected I would. Before I move on to management of crises, I've been talking a lot and haven't given people a chance to, talking too much. This is not a new thing, and it is effectively a form of regulatory arbitrage in these cases. There's a certain logic to thinking about it as functional regulation, and that would solve the problem a bit. That's the way to do it. Like if you think that the creation of money-like liabilities, that's what causes fragility, then why are we just going after banks? We should just be thinking broadly about the creation of money-like liabilities. And I think that's absolutely true. I think that the task for those of us in the research community is to come up with the carrots and the sticks that enable you to do that. So let me just give you an example for that. Gary Gorton and I have been trying to figure out how do you do that for repo. So repurchase agreements, they played a big role in the financial crisis. They're very money-like. And one of the reasons they're very money-like is they have a carve-out from bankruptcy. So if you enter in a repo transaction with somebody and you fail to give them the cash back, they can just keep your collateral. And even if you declare bankruptcy, the court can't go after them. It makes repo transactions things that you don't have to spend a lot of time trying to figure out if your counterparty is going to default because you know you can just keep their collateral, you don't have to worry about bankruptcy. So since that's what makes it money-like, we have proposed, fine, you can keep doing it, but if you want to have that protection, you simply have to register that you've entered into the transaction and you have to obey some minimum haircut, which would be the equivalent of the capital rule you would have on the same collateral if it was in a bank. Right? The idea is that the function here of creating something that looks like a bank should be regulated the same across these different things. That's one example. But all across this world, if we're going to do functional regulation, which makes sense, in a world where there's only a couple of institutions that could perform some activity, It was easy. You did your functional regulation by looking at the institutions. But now that it happens in markets, you're going to need to figure out what enables it to happen in markets. What's the set of legal rules the government hath giveth? When it's legal rules that enable you to do things, when it's the legal structure that enables market activities to happen, that gives you the carrot, right? To say, all right, well, if you want to enjoy these rules, then you have to play by, you have to either obey the same rules as someone else. So the general point that you're making, how different is this than regulatory arbitrage, the old stuff people said about functional regulation? I think it's not. I think conceptually it's the same. I think the challenges are trickier now because there's so many places that those functions can be done. Yes, that's how it worked going up to the financial crisis. It was all, there were basically master agreements between different banks. And they would lump together. This is Darrell Duffie. Darrell Duffie says the downside of clearinghouses, if you have a clearinghouse for CDS, then you can't offset the CDS stuff that you're doing with the other things that you're doing with these other counterparties. And that's the downside. That's the trade-off. But in general, that system did break down in 2008, which was the problem. That system broke down to the point that large institutions that had long-standing master netting agreements with each other simply weren't letting cash out their door. JP Morgan told AIG said, all right, well, we need $100 million, give it to us, it's ours. And JP Morgan said, no. So, to the extent it was sitting in these bilateral relationships, the bilateral relationships, what we learned, can freeze. So I would say, like, the issue there is with respect specifically to central counterparties is and this is maybe Duffie's main point, the more atomistic that central clearinghouse is, if it's only doing one particular thing, you're going to lose some of the netting you used to have before, even though you gain from bilateral to multilateral in that one instrument, you lose the ability for large bilateral counterparties to net across a lot of different instruments. So I think there's a trade-off, but there's no question that the old system, where the government was totally out of it and it was all, that froze. So we learned that can happen. And now we're wondering, well, let's not make it worse, but can we make it better? Good topic for research. Definitely going to bring up they're going to bring up the biggest banks from the very low levels they used to be at. One question is, will the small banks hold buffer stocks of capital above the new minimum thresholds? Were they just holding whatever capital they wanted to, or was it a buffer stock over whatever they thought the level was going to be? So one argument for why the smaller banks would hold more equity is they do the cost benefit. For them, the costs are kind of what they are for large banks, but not as big because they don't face as much competition. But the benefit of holding some extra capital is they can't raise capital that fast if they need to. So they have to have a bit of a buffer stock. So if overall the rules pop up, and they're popping up a little more for the big banks, but if overall the rules pop up, if part of the reason the small banks were bigger than the big banks before was because they needed this buffer stock, that effect will still be there. It would only be because of the extra amount, the extra percentage points that we're asking the big banks to do. That might tend to shrink it a little bit. But I'm still expect that the buffer stock incentive would be there. That in fact, what you're trying to design effectively is something that where the incentive for a counterparty for you in one of these things to go and produce information about it and have more information than you and introduce an adverse selection problem in your transaction is extremely low. So you basically make it, that's why you kind of layer debt on debt on debt on debt. And it's once that's broken, once you in a world where actually someone has an incentive to go and figure this stuff out, you don't actually go and figure it out, you just run. And that's basically what happens. So if you think like how transparent, so some of these CDOs, for example, people say, God, these are really complicated. But if you imagine where those assets sat before they were in the CDOs, they were on like the balance sheet of Goldman Sachs. So if I loan money to Goldman Sachs, I have no transparency at all about what's on Goldman Sachs. I mean, Goldman Sachs could change tomorrow everything that they have on their balance sheet. I wouldn't know. The CDO actually has some rules, And what happened is but the people who were buying most of these things were buying them because they didn't want to think about what their values were. They were saying, like, these things are AAA things, I just want to put them in here, I just want to use them as collateral. And so as soon as someone tells you, oh, you might have to figure out what this is, you just get rid of it. Well, I think basically this it comes back a little bit to the same thing about liquidity regulation. And I am getting too far afield, and I'll end up, people will think I'm a nutcase after I say these things. I need like 30 hours to explain this. It doesn't mean that you'll believe me when I'm done, but I need 30 hours to explain why I think this funny way about it. But what I'd say is this, in the end, if you think, let me see if I can get you to accept some just premises. If you think collectively what the financial system does, in great part, is do maturity transformation by taking all the long-run assets that actually produce stuff in the world and manufacturing things that can be used as transactions on the other side. So they have everyone's houses, old-style banks, they have everyone's houses, and they just have deposits. I mean, that's the simplest thing. But then the other version of it is you take everyone's houses, you mash them up 9 million times, and then you hand out a tranche of something that's AAA that someone can just use as collateral without thinking about it. Which is the same, I would argue, is the same thing. If you think the financial system is doing that all the time, and that it's effectively doing that to take advantage of a big carry trade and convenience yield, and that's where the incentives are, then it's very difficult to regulate that out of existence. I mean, you can regulate it out of existence in one place. You can say, like, you guys can't do it this way. But the incentive to do it is so big that somewhere we'll design a 40-chain NSFR, net safe financial ratio, net stable financial ratio. Funding, thank you. And these do two different things. One of them, the liquidity coverage ratio, says you have to have a certain amount of things that you could get out of the next 30 days. Okay? The NSFR looks at your whole balance sheet and kind of puts things into buckets and says how much of them have to fall into certain buckets. This is sort of like bank capital type thing. Neither of these things has a perfect analog in deep history. You can think of reserve requirements, like having to have a certain amount of cash sitting in your vault or sitting at the central bank, as being similar to an LCR, right? So you have to have a certain amount that's there, and it depends on what your average withdrawals are, et cetera, et cetera. But it's not a perfect analog, unfortunately. There's some things like the LCR that are sort of similar to the LCR that various countries put into place. So, for instance, the Netherlands had one in place pre-crisis. And there's a paper, I didn't cite it in here, but there's a paper, it's in the Review of Finance, like in the last couple of years, that studies that tries to look like, using some regression discontinuity stuff, because banks at different levels have it. So there's a little bit of that, but that's it, I would say, on the empirical side. I mean, there's a lot of study of liquidity and liquidity management at banks, but in terms of how they're going to react to these rules, and whether we're going to see stuff moving off their balance sheets, there's just not much yet. But we will see it because these rules are now starting to get, the rules are coming in, and they're coming in country by country in staggered ways. So that's going to be the place. Like, there's going to be hundreds of papers over time.
So what do you think, how long will it take, right, to accumulate some data?
Oh, I think it'll happen pretty fast after, I mean, banks are pretty quick at these things. We see it, these weekly horizons, we see things. In say the creation of asset-backed commercial paper and securitization. I would expect we're going to see these things happen at pretty quick horizons. What's happening, of course, is that they know it's coming, so they do all these incredibly weird design things in advance. For example, this is a completely pernicious one. So for commercial paper, like if you have commercial paper on your balance sheet, then is there some reason you think that the actual amount of equity they should hold relative to that properly measured risk-weighted assets would be different, small or large?
That's a very different question.
Yeah.
But the point is that there are different types of analysis.
Yeah, and so I think that's why now we have these debates about, so what you would be pushing back on, and I think you would have a lot of fellow travelers in this, is that to the extent you're going to impose a leverage ratio, a straight out leverage ratio of equity to assets. That, why are you doing that? The banks are really different in the types of assets that they have. And right now we have both a straight out leverage ratio and complicated tier 1 to risk-weighted assets ratios where we try to get that stuff right. So, and I think they're both hard questions. But you're right, it's easy to identify certain things. People say, well, the small banks aren't as well diversified. In general, they'll have like mortgages from the 10 miles around their bank. That's not that diversified. And which is the other, people often say, like, big banks are the problem. The problem is, not this room, I know, but out in the world, big banks are the problem. You just got to make banks smaller. You have to remind them, like, in the Great Depression, we had 30,000 banks. They were all small, and we had a horrible financial crisis, and we had financial crises, pretty much every 10 to 20 years historically without having big banks and without having government bailouts. So the complication in all of this, what I'm always kind of screaming and yelling at my co-authors about, so I can do it to you guys too. Is we can't, any of the things that we answer, if they fix the last crisis, if they make it so that the last crisis didn't happen, that's not good enough. Because the next crisis won't be like the last one. It might be some average of the last 50, but it won't look exactly like the last one. I'm sorry, you had a follow-up. Well, I'm absolutely certain that a clever theorist could write down a model where that would be destabilizing. But I'm not sure that would be the general case. But you might be able to convince me. And I discover I have like almost no time, so I'm going to I want to jump ahead to the big questions. Blah, 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 blah. All right. Managing, I told you I had too many slides, but they'll all be posted.
Big question at the end.
They will all be posted, I promise. All right. Big open questions in crisis management. I wouldn't want to leave without saying how important these are. Hundreds of programs in the global financial crisis across countries. I'm currently working on a project, we're just cataloging them. I'm not going to study all of them, they're too hard. Okay, there's hundreds of them. And just in the United States, actually, we had all these emergency lending programs. We've really studied a lot the TAF, the Term Auction Facility. There's a bunch of papers about that. Okay, on the capital side, we have TARP. We have a lot of papers on TARP, half of them written by Linus. Okay, so we have a lot of there's papers written on a couple of our programs, but then there's a ton of things. There's the Commercial Paper Funding Facility. It's hundreds of billions of dollars. There's almost nothing that's out there on it, and this is just the U.S. Every country did this. So and it's getting any stigma. Okay, why? Why would you be able to get any stigma? Well, there was one incredibly clever little design feature in the Term Auction Facility. I don't know how important people paid attention to the time. You could not get at the discount window, you go and you ask for money, you get your money the same day. Term Auction Facility, they don't give you your money for 3 days. What an incredible screening device. Nobody who's really desperate for money would go and have to wait 3 days to get their money. So you're actually willing to pay more to show everybody that you don't need the money the next day. Okay, there's like an incredibly clever little design thing. I don't know, some lawyer at the New York Fed came up with it or something like that, but it's ingenious. And hundreds of things all over the world. People tried all sorts of ingenious things, and we don't know what worked and what didn't work. So there's so much to do. All right, what principles emerge from these evaluations? What elements of program design would maximize confidence, minimize stigma, and have the lowest political cost? Okay, so we got to get to it. We just had all these disease outbreaks all over the world. We got to figure out what medicines work. Okay, and how should we now, during relatively calm times, best design the rules of the road for panic times? The wrong time to have these debates is when we're in the middle of a crisis, right? And so that's why what makes me nervous is we don't have that many papers on these things right now. We're waiting because it's boring, right? We're not having a crisis now. We have to set up our bank capital rules now, so we've got to do research on that. Well, we got to do this now. Okay, so I'm sorry it's late in the day and I've kept everybody 2 minutes late. I'm always guilty of that, but I'm going to hang around and I think it's upstairs where they're having drinks, right? Yes. All right, so anybody who wants to join?
Don't forget to subscribe and leave a comment below.